So why is it really important to measure your performance as a retail investor? What do I mean by that? You really need to know how effective your decisions are and whether you're actually making money from the decisions you've made. My name's Alan Capper. I spent 30 years in financial markets, either advising institutional investors or if not investing for my own account. I've also worked as an asset manager for a while. So this is the key question that I really want to address, and so many investors prefer to ignore this. They don't want to actually really drill down and understand how their investments are performing. Today, in this very short video, what I want to do is go through with you 3 good reasons why you need to know that information, why it's easy to calculate, and how you interpret it. So let's have a look at why you need to know how your investments are performing. In my view, these are the 3 reasons. The first is that, are you getting into the market or getting out of the market at the right time? Timing is critical in the markets, and it's really one of the hardest things to do for an equity investor or a fixed income investor, knowing when is the right time. So many investors think they're absolutely brilliant at this and they get timing right, and I think it's actually quite rare for investors to succeed in this. But maybe you think you do. Maybe you think you know you're getting into and out of the market at the right time. So if so, we really want to assess this. The second thing we want to really look at is, at a high level, are you actually adding any value? In other words, if you gave your money to someone else to manage, and there are plenty of institutional fund managers out there who will do it for you, will you get a better return? You need to give yourself some kind of comfort that if you're going to do this yourself, you're better than the professionals. Or at least if you're not better than professionals, you're at least as good. Otherwise, you need to be thinking why you're doing this. If it's a hobby, then that's great. If you think you get a thrill from it, then maybe you need to bear in mind this is not a casino and that there are cheaper ways to get betting thrills. My advice to anyone would always be, am I adding value? Am I doing what I think I ought to be doing in terms of getting the returns that I think are reasonable? And the last point is that at a micro level, chances are you're buying individual stocks and you're investing a certain amount in each of these various stocks. This is a very time-consuming enterprise because I imagine you're doing quite a bit of research to try and understand how these companies work. Now, of course, there's 2 alternatives to doing this. One is to get someone else and pay them to do it for you, an asset manager, and just buy an equity fund. But the other is to do absolutely nothing, buy an ETF which has exposure to the market, and sit there with the ETF. You really need to know whether your stock selection is outperforming the ETF, because the ETF is probably the cheapest way to get in the market. And if you're underperforming the market, i.e. you're underperforming the ETF, you have to ask yourself the question, why are you doing this? So those are, in my view at least, 3 of the many reasons why you need to know what your investment performance is. Number 1, you've got to have a clear idea that if you think you're timing the market and you're getting in and getting out at the right time, you're actually adding value by doing that. Number 2, does your macro allocation, in other words, do you as a portfolio manager add value relative to sticking this in a mutual fund somewhere and paying the cost of doing so? And number 3, for your individual stock selection, are you doing better than an ETF? Let's have a look at some of the ways that you can measure your performance. So the first thing you need to do is to know mathematically how to calculate your performance. And we all know that's based upon three things. It's the purchase price of what it is you bought, the sale price for when you realize the asset, or if not, the price now, and the income you're getting over that time period. If you want to know the formulas in depth, you can see them on my paid course, and if you want details of how to get there, just send me a comment and I'll respond with details of the web address. Or if not, you can see it at the top of this YouTube channel. So it's very, very easy to actually perform the mathematical calculation. Excel is going to do that for you. The key question to you is really going to be, what do you measure your performance against, and how do you interpret the results? So let's look at what you might be measuring your performance against. And we'll begin with that high-level question, am I adding any value? Well, you might think the alternative to investing yourself is to put the money in the bank. So one thing you could measure your performance against is what you're getting on your bank deposits. If that's not clear to you, because some banks either don't pay deposits or because it's difficult to see from your bank statements, there are lots of ETFs which effectively put money on deposit and leave it on the money market, and you can see what their performance is. And you can calculate it the same way as in your stock portfolio. So the first question you can ask yourself is my portfolio doing better than it would do if I just left all the money in the bank? That's obviously question number one, and it's the first question, but it's not really giving you the full answer, because no one just leaves all their money in the bank. Chances are they will have a portfolio of equity, gilts, property, whatever. So what you could do is you could say, I'll mimic an institutional investor, perhaps a pension fund, and I'll look at what their asset allocation is. Maybe they put 40% of their portfolio into equity, 40% is going into fixed income, and the remaining 20% perhaps into property or cash or other assets. And you could kind of build yourself a benchmark and look at the performance of your portfolio if you just stuck to that asset allocation. That, you might say, is your kind of neutral position. Now you can see whether your portfolio in aggregate containing equity, property, fixed income is outperforming that kind of benchmark. If it is, then clearly you're making some reasonable decisions and you're adding value. But if it's not, then you might really question whether you should perhaps give this money to an asset manager and to put it in a mixed portfolio and manage it for you. The key question, of course, is going to be, if you're underperforming really, really badly, then you really have to question your own competence. And if you're outperforming very well over a sustained period of time, and by a sustained period of time, I mean a number of years, not a number of months, then clearly you're doing a very good job. Now, another question you want to ask is, in terms of your equity portfolio, the choice of equities you're buying, is that a good choice? Are you adding value by selecting those names correctly? So here's the thing, what you could do is you could get an ETF, which, for example, invests in the US market, and you could look at the performance of that ETF, of say the S&P 500, and say, well, if I did nothing, I could just buy the ETF, leave my assets in the ETF and see how that performs, and I can compare how my stocks that I've bought rank against the ETF. And if I've severely underperformed the market, then I have to really question whether I should not be putting my money in the ETF instead. And clearly, if you've outperformed the market, then you're a great stock picker and you must know what you're doing. You need, of course, to use the right benchmark there. If all your assets are in the US equity market, then use an ETF which corresponds to the US equity market. If, on the other hand, you're investing in Japan, India, Europe, then you're going to need a global ETF which reflects all of the global equity markets. So it's really important to think, what is my investment strategy? How do I invest? And make sure the benchmark you use to compare your performance against corresponds to your own investment strategy. Now, the last point we want to address is timing. Are you good at getting into or out of the market at the right time? So what you can do is, let's say we look at a time period of, say, 1 year. One option is to just buy an ETF at the beginning of the year and hold it until the end of the year and look at the returns you've got from that. And then compare that to the returns you've got on your portfolio when maybe you were long equity from January until March, then you sold out a chunk of your portfolio, and then the remainder was giving you cash returns, and then you went back in later in the year and then out again in Q4. You can compare your returns against someone who just stuck with the market through thick and thin through that entire period. And it'll give you an idea whether you've been getting in and out at the right time. This is really, really important because it's expensive to get into the market. And as a result, you want to be very, very careful to make sure that all those transactions to buy and sell stock, and that time, of course, you're putting into it, is really worthwhile. So there's three things, three ways of measuring your performance. And I think they're all of them equally important to the investor, because it's not only important to understand, am I outperforming something, but why I'm outperforming. And the reason why is so important is most investors are not competent at everything. Some are good at timing, some are good at the high level allocation, some are good at stock picking. You will need to find out where your particular competence lies, and that's really where you want to focus your attention. If you're particularly good at choosing sectors in the US equity market, then you need to know that, and that's how you should be making your money. And if you're hopeless at deciding whether to be in the market in January or February, or when to get in or when to get out, don't try and play that game, because if you keep getting it wrong, then it's clearly not a productive enterprise. So measuring performance to understand your own competence is really, really key here. So I hope that video has given you some additional colour on why institutional investors measure their performance. Any retail investors should be measuring their performance as well, and why it's so important for you. I hope you find it useful. If you have, please do click like, please do click subscribe. And if you want more details on how to measure your performance, either in terms of the maths or in terms of why and how you should do this, have a look at my paid courses, and you can see those on the link to my website, which is on the YouTube channel. Anyway, thank you for watching. Hope this was useful. See you again for the next video.